I'm excited. I enter 2025 with optimism. We can get that flywheel spinning in a major way, and it's been stuck since Q1 2022.
Well, Ryan, thanks for joining.
Thank you for having me.
And great to have you at the Exchange. Obviously, Insight is coming into a fantastic year, anniversary year.
It is a big year for us, the magic number 30. And we're especially excited about this number 30 because our number 25 was disrupted by COVID.
So congratulations on the 13th fund.
Thank you.
What are you kind of looking for in terms of investment opportunities for 2025?
But the Insight founding thesis was pretty simple, that software is special. It's one of the greatest business models, if not the greatest business model ever invented. It really hasn't changed since 1995 when this all began for us. We want to work with the best companies in the world and hope that we are the first choice of any scale-up software company on the planet.
Take us back to the first investment that you made.
My very first investment ever was into a company called Punch Software. And Punch Software is a home design software package. And it was sold predominantly through retail, like through Best Buy or any of the retailers like that. So shrink wrap software sold in a box. This is long before downloadable software. And I loved the product.
Right. Now that investment, did that go public?
No.
Okay.
Oh no, a very small company. It ended up getting bought by a small public software distributor about 15 years ago.
What was the first investment that you made that ended up actually getting to the public markets?
The story that I'm the most excited about is not the first that I was ever connected to, but the first where I was the lead, like the partner that led the deal.
Yeah.
And it was a then small company in Bellevue, Washington, with all of 8 million in trailing revenue. They were 8 burning 8, going to 16 burning 16. So when revenue equals -1 times profit, it's always a question of, okay, what can this be? And that company was Smartsheet.
Oh, wow.
And I had no delusions of ringing the bell right behind me here someday. But after 5 years working with that company, it was the first transaction that I led that ended up experiencing an IPO right here. And they invited me to stand up in the balcony with them, which was just such a magical moment in my life and career. And it's been really exciting to watch what Mark Mader and that team have continued to do with that company.
That's fantastic. When you kind of think back to what originally attracted you to Smartsheet, what were some of the things that kind of turned the light bulb on and say, like, that's the reason why I want to get into it?
There's always a desire to understand what are you competing against when you're investing in something innovative. It's like if Excel or Google Spreadsheets could do the job, then why are Excel and Google Spreadsheets using this product?
Right.
Was an interesting question. What they did wasn't just competing against spreadsheets. They were really competing against 3M. They were competing against Post-it notes. These little reminders to get things done. It was really a project management tool masquerading as a spreadsheet.
Right.
And that innovation was clever because people intuitively knew how to use spreadsheets. So they were able to create this form factor which made what would otherwise be a brittle, they used that word brittle. I remember the co-founder calling it brittle Excel spreadsheets, replaced by this durable and very specific project management function that is very easy to learn. So the aha of spreadsheet brittle, Smartsheet durable, and not competing against Excel, competing against Post-it notes was like the two magical moments in my head to say, wow, every single knowledge worker could be a customer of this product.
Oh, that's interesting. That's interesting. I know for me, when I've taken companies public, especially like the first few deals that you work on, those are very pivotal moments. You kind of take away a lot of value-added lessons in terms of when I do my next deal, I'm going to keep this in mind in terms of, as I think about the process. You know, you think back to Smartsheet.
One of the things that I appreciated about the Smartsheet story in particular was our deep understanding of cohort math. And as a franchise, we've spent a lot of time thinking about not just a singular metric like gross retention or net retention, but how does the behavior of each successive group of customers, 1 month or 1 quarter at a time, compare or differ from the prior ones? And one of the phenomenons that I appreciated in their story was there was a virality to it. Like it was expanding, but at a glacial speed. It wasn't instant viral. It was every cohort was just a little bit better than the last one. And I remember in writing up the possibilities, the hardest prediction to make in that business was just how good could they get? The cohorts, I mean. If you stopped after 4 more improvements, it was one answer. If it never stopped getting better over 15 quarters, well, it's a very different answer. And so to me, a lot of the magic of what was possible in that deal lived at just how much better can we make our land and expand strategy. And I have borrowed from that storybook many times in looking at other deals where a land and expand motion can lead to a very prolonged and continued cohort improvement. It's just one very specific example of a lesson, because if we just looked at retention alone, retention wasn't that good.
Right.
Because a lot of people will try it for a month or 2 and quit. You had to look past the 90th day and say, what if it's, just think of it as a 90-day trial, and starting on day 90, then I look at my retention. All of a sudden, conventional 85%, 90% worked. But if you didn't look at those 90 days, it was like a 65% retention rate, which one could just interpret as bad. So lesson, look more deeply than a single metric, and it served us very well.
That's great. Did you find that during the course of the roadshow and kind of talking to the public side investors, did you find that they saw that as well, or at least the smart investors?
Well, and I'm going to take it away from the Smartsheet specific case. One of the hardest parts of being public is anything you share, you're making a determination to share forever.
Exactly.
And this is a huge breach between the world of private investing and the world of public investing.
Absolutely.
As a private investor, I can get the entire data cube, every line of it, and I can run my cohort math however I want. And if you look at the reporting of many public companies, there's usually some very significant qualifiers for how retention is calculated. Things like, I'm excluding any customer under this big,
right,
or any customer under some other metric. And so what you never know fully is what proportion of the universe is representative in the stats that are being presented. And if you listen to any SaaS company earnings release, many of the questions that come from the research analysts are trying to poke at, is that retention number covering 40%, 80%, 90%? Sure. Like what is the relevant piece of it? So we couldn't tell the story to the street exactly as I told it internally, because the metrics that one reports have to tell that story. So once you're at a public level, I suspect the hypergrowth is a little bit calmer. Yeah. And all of a sudden, the easy, gross, and net singular numbers become more indicative and more useful. And that tends to be what companies report as they get public.
Yeah. If you were to kind of thinking through that and giving advice to a company that is in the SaaS space now, what would be some of the pieces of advice that you would give?
For metrics?
Yeah, for metrics. Especially given today's environment, which is very different, obviously.
Well, the easiest advice is obsess over the metrics. Yeah. I find myself incessantly repeating obsess over the metrics in many a boardroom. Yeah. So I'm sure CEOs and teams that I work with will chuckle if they watch this, because I'm a bit metrics obsessed. And it's not because there's a right or a wrong metric. Like, it's not that this percent is right and this percent is wrong, or this LTV to CAC is right and this LTV to CAC is wrong. It's that if you're not measuring it obsessively and doing your best to attribute the changes you're making to your sales and marketing engine or your product and what effect they have on acquisition cost or retention rates or average order values, all of those pieces, if you're not measuring that, you're vulnerable. And I don't think it's ever too early to start really driving that metrics orientation. My number one point of advice would be build that infrastructure as early as possible and have every department understand their role in what they're doing and how it relates to unit math. Yeah. Because that unit math will ultimately drive not only growth rate, but profit level. Yeah. And the profit understanding and intricacies are amongst the most important things right now for public investors to understand.
Yeah. Yeah, I think I'd also add is that when you look at the public process nowadays, it's taking longer for companies to get public. And so the more that you can not only tie what those metrics are, but also deliver on the results of those metrics over time as you're going through the process of talking to investors pre-IPO. That also results in a better outcome during the public process as well.
The better behaved the metrics are, the easier it is to extrapolate. 100%. This is one of the greatest ironies in everything you and I do. Yeah. The first page of every deck says past performance is not indicative of future results. And the first thing every analyst does is they extrapolate past performance to suggest future results. Now you disclaim that it doesn't mean it will necessarily happen, but the best indicator you have of future results is the past. And if you have bouncy numbers, pick one, if your retention bounces from 82 to 93 to 86 to 74 to 99, 99 is great,
right?
But volatility is not great.
Exactly.
And so stability and predictability and understanding what could change or what will not change in the market that helps you either preserve or maybe distort your numbers. That's the pitch that really gets made. And you will see there's a high correlation between multiples and quality of unit economics across every SaaS business, because the math has really standardized where people understand the importance of gross retention, people understand the importance of gross margin, people understand the importance of efficient new sales acquisitions.
So, there's been a lot of talk. I'd say one of the kind of consistent themes or talking points we've seen over the last year has been the question around what top line ARR do you need and what growth metrics do you need? Do you need to be profitable to get to the public markets? What's your perspective?
There's no literal line, but you need an offering of sufficient size to make it worthwhile.
Yeah.
And I'm just going to round that to $250 million. Like if you're having an offering of less than $250 million, I think you're getting pretty thin in likelihood. And you're not going to do a $250 million offering for 40% of the company. It's not how it works. It's going to be a relatively narrow sliver of the company. And that tends to line up $1 billion enterprise value as sort of the minimum size to ride the ride. There's exceptions to it, and I'm sure we could find reasons to have that be different. But by and large, that tends to be the level. And so, backing away from that, what scale does that suggest? And there's a bunch of methods, but it's pretty hard to get that under $100 million of ARR, at least in the forward year. Most companies wouldn't want to be public at just 100 million of ARR. So you have all of these constituencies, that series of paradoxes that it takes to get public. What the underwriters and investors want isn't necessarily the same as what the management teams want or what the existing boardroom wants. So I think it's north of 100 million. It's probably north of 200, but it doesn't have to happen by any. You could be $1 billion of revenue and have your initial offering. But I would say over 100 is when the conversation gets interesting.
Yeah, definitely. Yeah. And I think you also see that in the performance of larger size transactions post-IPO. Larger size deals tend to perform well. There's a greater institutional following. There's greater research following.
Better liquidity. You don't want one person selling one share to move the entire stock price. So a deep stack of investors and a varied and wide ownership group is helpful for price stability. Otherwise, one or two small transactions moves the marginal price.
Absolutely. Totally agree. As we kind of think about 2025, there's been a lot of expectation that this is going to be a big year for IPOs for a variety of reasons. But how do you think about it? What do you think are going to be some of the factors?
I was thinking about this walking in. So it happens on this morning. It's very cold. It's 22 degrees outside. And I was thinking at how nice 40 degrees would feel. Because relative to 22 degrees, 40 degrees would feel balmy, but it would feel really, really cold on a summer August day. I think the same is true in IPO markets. And so I hear people talk about the really, really good year for 2025. That's kind of like the 40 degree day relative to 22 degrees. It is not hard to have a really, really good year relative to the anemic years of 24 and 23. And so to me, it's a continued increasing of the temperature as I extend this analogy, where a company goes public, it goes well, it encourages 2, 3, 4 more to go public, they go well, and all of a sudden the barriers to getting public, the emotional barriers to getting public,
Yeah, it's
come down,
Yeah.
and you see a lot of companies push it until you reach a new equilibrium, and you're at a new normal.
Right. Yeah. Yeah, I'd agree with that. I think it's interesting because on one hand, you have from a secondary market perspective, valuations at an all-time high. You have multiples in most sectors, software put to the side, but in other sectors, trading close to an all-time high. You have volatility, it's relatively low. The rate environment and backdrop looks very favorable. And from a fiscal perspective and from a tax and regulatory perspective, things look pretty positive going into next year. So the backdrop looks fantastic. And I think the challenge is going to be likely as people look towards, your advice to say like, well, why not go? You have all these tailwinds. Now's a great time to be in the marketplace. So for software, the question would be, well, why not go?
I mean, it's more complicated than just the answer of am I public or am I not public?
Right.
I believe the why are you going public needs an answer besides because it's there. This is not Mount Everest.
Right.
You imagine going and running software companies is a battle. So imagine in a war sense, going to battle and exposing your entire blueprints and plan to the other side, and then still going and having that battle. That's a little bit of what the IPO journey is like. You're exposing your entire plans and expectations for the world to see, including your competition. And so it takes a very special company to endure not just the path to getting public, but the minimum of 8-quarter journey of beat and raise, beat and raise, beat and raise to create an expectation of what your growth trajectory and profit potential can be.
Yeah.
And so until you have that well mastered, it's hard. And it's very tricky to accept 8 quarters of predictability when you've had not yet 8 quarters of well-behaved anything. I always talk about you need like 4 to 5 quarters before you start dipping that toe into the water with no bad stuff happening.
Yeah.
And if you think about since COVID, really, from the moment of the Great Reset in Q1 2022,
Right.
there's been something seismic somewhere, somehow, over and over again.
Yeah.
There have been wars, literal wars.
Right.
The
Right.
interest rate regime going this way,
Yeah.
which was new for, anybody younger than me never saw LIBOR or SOFR 500 before, and that's now a thing. Don't forget the SVB impact, and that's not even 2 years old.
Right.
We had a major election in November of 24 that had uncertainty. And so, yes, we're at a moment where all of the indicators you talked about could be favorable ingredients, but you still need absence of chaos in the markets.
Right.
And anytime a chaotic agent is thrown into the markets, you probably have a couple quarter hold until it resets the cycle again. So what you bet for to have the IPO market open wider is relative stability and absence of chaos.
Right.
And unfortunately, they're really hard to predict. But because the capital markets have gotten so deep in the private markets, access to capital is not the catalyst to go public. It's the branding and the forever potential of being a brand that becomes the next $1 trillion thing. That's a big part of the drive.
Yeah. And you also, I think, wrote a recent article, which I thought was really favorable for a lot of companies, management teams, boards, as they kind of think about that process in terms of IPO windows generally.
Yeah.
It's not just about the IPO event itself, but it's about thinking about from the board's perspective, the management team's perspective, the investor's perspective. Maybe talk a little bit about that.
Yeah, I call it the series of paradoxes that get a company from private to public. And the colloquial notion is there's these windows that are open and shut. And I argue that oversimplifies it. It's true, it's accurate. Windows are open and shut. But how they shut, why do they shut so fast and open so slowly? And there are 4 paradoxes that have to be aligned. Management wants to wait forever, and they want to get going already. Like they want to just get the puck on the ice, and they want to wait forever to have everything perfect.
Yeah.
And that's the paradox.
Yeah.
You've got to resolve that psychologically. A board wants to prolong for as long as possible the moment they have to share their battle plan, the blueprints for as long as possible. But yet They want the ability to have a public currency maybe for acquisitions or other things that are beneficial. So the board has to get alignment. The underwriters want the best possible price and the lowest possible price.
Right.
And it has to fit inside
Right.
the market conditions. And so you need market conditions to be high so that your discounts, you want to discount a high number, not a low number. So you need the underwriter paradox to kind of work out. And then the investors, the event of an IPO flips everybody into common stock, certainly on this exchange.
Yeah, certainly.
And by being in common stock, all of a sudden, if things don't go well and there's a significant repricing, there's exposure. So the investors have to have high confidence in the durability of the valuations. And that's a big paradox because you want to have the IPO for that big potential pop in future value, but you want to make sure that your downside is still protected. So the window shuts if any one of those four things is a no. You need 4 yeses. Yes, 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 yes. And then and only then is it open.
Right.
And they open, each switch flips on at a different speed. So the first one to flip down, IPO window shut. And not until the last one's back on is the IPO window back open. And so this notion of window oversimplifies, and lining up this, it's like a major miracle, I think I use that word. To get it all lined up is a very tricky thing.
Yeah.
That's why they shut quick and they open slow.
Yeah, and you've done this multiple times, but as you know, the process of getting a company into the public markets takes time. So for a management team, aligning all those different constituents, it's not a 1-year process. It takes multiple years to try to get ready to do. So in the backdrop of a market with a lot of volatility, it's obviously even more of a challenge.
Well, and there's different pieces. I mean, you want your team relatively stable for at least a year. And by team, your head of revenue, your head of finance, your CEO, depending on how heavy the tech burden, probably your head of technology, at least those 4 roles in place for at least a year to have a cadence and just the confidence. You'll need your legal process and your hiring process all ready to go. That could be a little shorter.
Your board.
The board is probably, you want that in place 6 months or more in advance.
Yeah.
So I think it can be done in 6 to 12 months if your requisite pieces like team are already in place. And it's really hard to wake up on a Friday and be like, I want to be public by this time next quarter. It just doesn't work that way.
Right.
And it shouldn't be such a hair-trigger decision that it's clearly a yes or clearly a no.
Right.
It's a judgment. And that paradox of I want to wait until everything's perfect, or I just want to get going already, that you're navigating that dynamic quite a bit in that final moment to say, yes, now is the time.
Yeah. And I think I'm also a big believer that ultimately it is a moment in time, and you still have to run an effective public company afterwards. And so the preparation and all the legwork that goes into it ahead of time is great, but ultimately as a management team, you still have to actually be prepared to run the company going forward and have predictable results.
So I push back very hard when people talk about IPOs as exit events. They are not exit events. They're just another capital raising event where your blueprints have been exposed to the world and you're now quite literally on the clock on a quarterly basis. And that's just a different mindset. The benefit of that is now each individual investor, including your employees, can make their own decisions as to when liquidity is appropriate for them. That's good.
Yeah.
You get the benefit of a public currency for acquisitions. That's good. And you can become a $1 trillion company. There is no $1 trillion private company. I'm not aware of any. You can correct me if I'm wrong. They're only a matter of time. But to have the truly massive generational outcomes that can exist, it is a necessary step.
Yeah.
And so it all comes back to what is your motive and why and how does it help you? And a lot of it comes down to the big branding moment that it can be for the company. Chief marketing officers love IPOs.
Exactly. It's interesting. You touched on that element around there is no $1 trillion private company yet. Obviously, the IPO has served as a great opportunity for wealth creation for a variety of different stakeholders over time. But obviously, the private markets have an incredible amount of liquidity and capital available. How do you think about public versus private markets, the trade-off, and the opportunities for companies as they think about capital?
It's an interesting one because it's not a singular answer.
Right.
I think one of the biggest differences in the 30 years Insights existed is that the rise of private equity as a buyer of primary resort for software companies. That once upon a time, private equity selling to private equity was rare.
Right.
Because people thought, well, if you're selling, what do you know that I don't know?
Right.
And the world has evolved where the investors that give private equity firms money, the so-called limited partners of the private equity firms, they're measuring private equity firms on speed to capital returned, as measured by the rate of return, so-called IRR.
Yeah.
And that has created this ecosystem where private equity can sell to private equity, can sell to private equity over and over again. And so what you have is a bit of a bifurcation of, are you a long-term growth story that is unlikely to have near-term high profit potential, yes, but unlikely near-term profit potential. You're probably swimming more towards an IPO trajectory or a strategic acquisition. Or are you trending towards a high profit, moderate growth story? If so, you're almost certainly excluded from from the public markets. Public markets don't like debt, and they don't like subscale growth. So private equity has really taken all of that piece of the market where you're kind of 20% or lower growth, high profit. And so you're limited now on the higher growth companies.
Yeah.
What subset of those become public markets? And that depth of the private markets lets them stay private for longer. So it depends on exactly how high your growth rate is, exactly how big your market is, how much better your mousetrap is, and all of the features that can make a decision for IPO being appropriate.
So obviously, as you mentioned earlier, 2024 was a pretty momentous year in terms of the election, global elections, really. And if you kind of think about 2025, how do you think about the outlook, both in terms of what you're looking forward to for the fund, for Insight Partners as a whole, and also for yourself?
It's been a long 5 years because you have the scary part of COVID, whatever that 21 period was called, the euphoria, then the hard come down, and then the great reset, and then all the kind of way back. And so I'm just rooting for normal to stay normal. I don't need a radical up. I just need more extended normal. And we talked about some of the writings that I've done. Normal doesn't become normal until it's repeated a couple times in a row.
Right.
And so I think 2025 has the potential to be another normal year. And what that should mean is valuations which are still hugging relatively low levels as measured against the past 15 years. I mean, Magnificent Seven aside, the rest of the SaaS ecosystem is still sitting on the lower edge of the 15-year average. By having predictability and normal persist, that should gently drift up. The multiples should drift up. That's good for everything. That's good for all equities in the SaaS ecosystem. It's good and necessary for more tech IPOs. It's necessary for successful IPOs. And those things beget success.
Absolutely.
A couple more successful IPOs that have prices that stick will increase multiples, and it just starts this flywheel effect. I'm excited. I enter 2025 with optimism. We can get that flywheel spinning in a major way, and it's been stuck since Q1 2022. So that's my hope for the year and all of the good things it means for everybody else along the way.
That's fantastic. Awesome. Thanks a lot for coming on.
Thank you so much for having me. It's a real
great
privilege.
Conversation.
Love being in this hallowed space.
Yeah, great
It's good
having you
stuff.
here.
Thank you.